Understanding stock loss tax write-offs.
Hello there. Today we'll be unraveling a commonly used strategy in investment, called stock loss tax write-off. This is a crucial concept for any investor as it can help you balance your profits and losses in an efficient way and reduce your taxable income.
What is a stock loss tax write-off?
A stock loss tax write-off, also known as a capital loss deduction, is a tool provided by tax laws that allows investors to deduct the losses they suffer from the sale of stocks from their taxable income. This strategy is beneficial because it reduces the total amount of your income that is subject to taxes. However, it's important to remember that only losses resulting from the sale of assets qualify for this write-off. Unrealized losses, or the decrease in value of stocks that you still hold, don't qualify.
How does a stock loss tax write-off work?
To utilize a stock loss tax write-off, you need to calculate your capital gains and losses first. The profit from selling stocks at a higher price than you bought them is called a capital gain. Conversely, selling stocks for less than the purchase price results in a capital loss. Once you've calculated your gains and losses, you subtract your capital losses from your capital gains to find your net capital gain or loss. If your losses exceed your gains, you have a net capital loss. Under U.S. tax law, if you have a net capital loss, you can use it to offset other taxable income. Up to $3,000 of net capital loss can be deducted from other kinds of income in a given tax year. If your net capital loss exceeds $3,000, the excess can be carried forward into future years until it's completely used up.
What are the different types of capital gains and losses?
Capital gains and losses can be classified as either short-term or long-term. Short-term gains or losses come from selling assets held for 1 year or less, while long-term gains or losses come from selling assets held for more than 1 year. This distinction is crucial for tax purposes as short-term and long-term gains are taxed at different rates. The tax rate for long-term capital gains is usually lower than the rate for short-term gains. So, when you're calculating your net capital gain or loss, you need to subtract short-term losses from short-term gains and long-term losses from long-term gains first. Then you can subtract long-term losses from short-term gains or vice versa if needed. Understanding the concept of stock loss tax write-offs can be a game changer for investors, as it's a useful way to mitigate financial damage from unsuccessful investments. It's important to always consider tax implications when creating your investment strategy. Please consult with a tax professional or financial advisor for advice tailored to your specific circumstances. We hope you found this video informative and helpful.